So we have in the books of Hotel Nova Goa, Hotel Nova Goa, trading profit and loss account for the year ended 30th June 2002, because the year started in July. 30th June 2002. Similarly, we have the profit and loss appropriation account. We have the partners capital account here. Since there are no current accounts, partners capital account. Partners capital account. And here we have three partners, X, Y, and Z. There are three, I'll just increase the size of this. And we have the balance sheet as on 30th June 2002. 30th June 2002. So let's start with the items. The capitals are all the credit balances. They are directly transferred to the partners capital account. So X, Y, Z, 1 lakh 80, 90 and 60. So by balance brought down, the capital accounts will always show credit balance. The current accounts can either show debit or a credit. Okay, capital accounts will always show a credit balance. By balance carried down, sorry, by balance brought down, 1,80,000, 90,000, 90,000 and 60,000. Then we have drawings which come on the opposite side. 12,000, 9,000 and 6,000. Two drawings. $12,000, 9,000, 6,000. Then there is a purchase of provisions, 2,40,000. Now, since purchases is not the first item and we have opening stock, I will leave a line for purchases. I will leave a line for opening stock and write the purchases. To purchases of provisions, 2,40,000. Then there is sales, 5,85,000. Buy sales, 5,85,000. Then we have the opening stock, 10,500. Premises, which will go in the balance sheet, 2,25,000. There is no depreciation, so directly in the outer column. Premises, 2,25,000. Why I'm putting it in the outer column? Because they have not told us anything about depreciation and premises. So 2,25,000. Wages and salaries, 1,47,600. Two wages and salaries. In the inner column, because it's an adjustment, 1,47,600. There's outstanding salaries. Rates, 24,900. I'll just leave some lines for the balancing. Two rates, 24,900. These are expenses in the profit and loss account, rent and rates. Postage and telephone, 9,150. To postage and telephone, 9,150. Then there is kitchen utensils equipment 25,500. Just make it a short form. 25,500. This is there's depreciation on this kitchen equipments, kitchen utensils. So in the column. Then we have bank balance 1,32,000. I'll just leave some lines for the other assets. Bank balance 1,32,000. Uh, Printing and stationery 4,950. 4,950. Then there is cash 1,350. This is cash in hand. One three five zero. Then we also have insurance 5,100. There's an adjustment to this prepaid insurance. To insurance 1,500. Sorry, 5,100. Then there is creditors 24,000. Now we'll leave a line for the capitals. Creditors 24,000. Gas and electricity 28,050. Then there is restaurant furniture 26,400. Restaurant furniture 26,400. Then we have China and linen 9,150. Office equipment 6,450. I didn't leave space for that. I'll write it below. Office equipment 6,450. There's no depreciation on this. Yeah, it's only on furniture, kitchen utensils, and china. Office equipment 6,450. Discount. Now this is discount earned since they've just had discount, but the fact it's a credit balance, we know that it is discount earned. So it's going to be discount received on the credit side 3,000. Leave space for gross profit by discount received 3,000. Visitors ledger 3,900. These are your debtors. I explained this right in the beginning. Visitors ledger 3,900. And repairs and renewals 15,000. To repairs and renewals 15,000. Now coming to the adjustments. Closing stock of provisions is 12,000, so that becomes by closing stock. $12,000. Then there is accrued salaries 2,100. This is outstanding salaries. Two outstanding or accrued salaries. The amount is 2,100. That comes to 149,700. 149,700. And similarly, we need to show accrued salaries in the balance sheet. $2,100. Accrued electricity 1,500. Sorry, this is not two here, this is add. Accrued electricity is 1,500. So add, accrued means outstanding. Add accrued electricity 1,500. That comes to 29,550. 29,550. Similarly, we show this in the balance sheet. Accrued electricity 1,500. Prepaid insurance 1,200 less prepaid insurance 1,200. Why we minus prepaid? I had explained yesterday, because for next year it is prepaid this year itself. So if you don't minus it, you will be showing extra expenditure of this year, and hence you will get a wrong net profit. Okay, so this year's expenditure has to be shown in this year, next year's expenditure needs to be shown next year. So less prepaid insurance 1,200, this comes to 4,100, 3,900. And similarly, this is an asset, so prepaid insurance 1,200. Then there is depreciation, 12% on furniture, 12% on furniture, less depreciation. So 12% of 26,400 comes to 3,168. 3,168. So minusing that, we get 26,400 minus 3,168, we will get 23,232. 23,232. Okay, we need to also show this depreciation in the P&L account. So 2 depreciation on furniture 3,168. 3,168. Kitchen utensils, they've directly given us the amount, it's 4,500. So less 4,500 here. Less depreciation 4,500. So that comes to 25,000. 500 minus 4,500 comes to 21,000. Need to show this in the profit and loss account on kitchen utensils and equipment. 4,500. Then there is China and linen were revalued at rupees 7,500. So that's the new value, 7,500. Old value is 9,150. New value is 7,500. The difference between the two, so the new value is 7,500, old value is 9,150. The difference between the two is the depreciation. And that comes to 1650. 1650. So the depreciation on China and linen is 1650. Next we have, okay, provide interest on capital at 5%. Provide interest on capital at 5%. So now since interest on capital is an expense to the business and an income to the partners. So two interest on capital. We have three partners here. We have X, Y, and Z. So the percentage that's given is 5%. So 5% of their capitals. So 5% of 1,80,000 will come to 1,80,000 into 5 divided by 100 comes to 9,000. 5% of 90,000 is 4,500. And 5% of 60,000 is 3,000. Okay, so this is the capital that has been provided. This is the interest on capital that has been provided. This is an expense to the business and an income to the partners. All payments made to the partners, which are all payments made to the partners, are shown in the profit and loss appropriation account and adjusted either in their capital account or the current account. So this is going to be an income. By interest on capital comes to 9,000, 4,500, and 3,000. Okay. Any questions with regard to this? Anyone has any questions with regard to this? Next one, X and Y are entitled to salaries of rupees 12,000 and 15,000 respectively. So only X and Y get salaries. Two salaries. Okay, X gets 12,000 and 15,000. X gets 12,000 and Y gets 15,000. So again, this becomes an income for the partners. By salary, X is 12,000, Y is 15,000, Z is not given any salary. Okay, and I think that's it. The last thing, yeah. Now we need to share the profits. To share the profits, we'll have to start closing everything. So first we start with the trading account. So the total here will come to 5,85,000, 5,95,000, 5,97,000. 5,97,000. The gross profit here will be to gross profit. That comes to gross profit, I'll say carry down to the profit and loss account. 5,97,000 minus 10,500 minus 2,40,000 minus 1,49,700 comes to 196,800. 196,800. Bring down the gross profit by gross profit brought down 196,800. So now we know the gross profit. Now we can find out the net profit. So the total comes, this side comes to 199,800. 199,800. The net profit to net profit. Okay, this comes to it comes to 103,032. 103,032. So this is the net profit after providing for all the expenses of the business. So yeah, we had calculated the net profit. The net profit comes to 103,032. Now this net profit has to be brought down to the profit and loss appropriation account. It has to be shared between the partners, because even for the sole proprietorship, since there's only one person, entire net profit is added to the capital in the balance sheet. But here, since there is more than one person, it needs to be divided among all the partners. So I will say by net profit brought down is 103,032. 103,032. Now this net profit, from this net profit, we need to provide for all these expenses. Okay, we need to provide for all these expenses, which is the interest on capital and the salary paid to partners. So let's check what we get. So the total here will be 103,032. 103,032. Now just pay attention how I'm doing it if you all did not understand it yesterday. So once you bring down the net profit, from this you minus all the expenses, the interest on capital and the salaries, whatever payments have been made to partners, and the remaining has to be divided in the ratio that is given to you. In this problem, it's 5:3:2. So if we minus all this from 103,032, we get minus 13,500 minus 30,000 comes to 59,532. This comes to 59,532. Now this 59,532 is the actual net profit, which after providing for all the expenses, whether it's business expenses or whether it's any payments to partners, this is what is left. And this is what is going to be divided among the three partners. Okay, so to net profit. So X here gets X, Y, and Z. So here 59532 has to be divided in the ratio of 5:3:2. Okay, so that will give you 59532 divided by 10. Divide by 10. Why divide by 10? 5:3:2. Total is 10 into 5. Divide by 10 into 5 comes to 29,766. 29,766. Then Y 59532 into 3 comes to 17859.6. 17859.6. So I will make it 17860. This comes to 17859. 170,859.6. So 59.6, I've rounded it up to 60. And the next one into 2 comes to 11906, 11906.4. So we will keep it as 11906. Whatever it is, this total has to come to 59532. And if you check, it does come. That total has to come to 59532. Okay. Now this is the net profit. Again, this is an amount that is being paid to the partners. So again, it will be like an income for them. So by net profit, which is shared between the partners, 29,766. Then we have 17,860, and we have 11,906. Okay, so this is what is this going to give us now? This is going to give us a final new capital, you can say. It's going to give us a new capital. So the total here comes to 1,80,000 plus 12,000 plus 9,000 plus 29,766 comes to 230,766. This side we have 127,360, and then we have 74,906. 74,906, which will give us the new capital. Okay, so to balance carried down, this is the balancing figure. This is what we are going to transfer to the balance sheet. This is what we are going to transfer to the balance sheet. So 237,666 minus the 12,000 will give us 218,766. Then 127,360 will give us 118,360, and 74,906 will give us 68,906. Okay, so basically what has happened at the beginning of the year, we started with these capitals with all the additions that have been made, okay, and minusing the drawings. These are the new capitals. So if you see all the three partners, their value of their capital has increased. The value of their capital has increased. This capital has to be transferred to the balance sheet. Capital X, Y, and Z. You can either write it directly in the outer column, or you can write it in the inner column and show each one's total. So X has a new balance of 218,766. Y has a balance of 118,360, and Z has a balance of 68,906. So the total of this comes to 218,766 plus 118,360 plus 68,906. We get 406,032. And then the final balance sheet total will be 433,632. 433,632. On both sides, 433,632.